When we look at the history of banking in this country, it all started with international banks, then quickly followed by government banks. And African enterprise in banking came late. Because of the barriers of entry, they never started as banks. They started as finance houses and building societies. And that's also where equity came in back in 1984 as a building society. The reason why they used different modes of entering the financial sector was affordability, was accessibility to licenses. So these were what you could call lighter regimes or organizations that were a stepping stone towards becoming banks. The building societies were built on an archaic legal framework of 1948, the old Mutual Act of United Kingdom. And essentially, it was a very restrictive law, in the sense that a building society were not participating in clearing houses. They could not offer current accounts. They could not deal with foreign exchange. Consequently, they could only then deal with the clients who were in a niche that didn't require those type of sophisticated products. So essentially, equity started as a building society serving tea farmers, rural communities, and in urban centers, serving what you could call like the Nairobi City Council, then low salaried staff. So it was more of one of the majority in society, what you could call bottom of the pyramid. That was the niche that building societies were serving. It is true, after some time we realized the building society concept had its limitations. And as I said, the first one was the range of products that you could be able to offer. The convenience of the checkbook was not available. The clearing of transactions. So it then became apparent that building society was just a first step before becoming a bank. And so we started the migratory path of transforming and converting into a bank, so that we could be able to offer a wide range of financial products to the people, and also move to a more robust legal framework under the Banking Act, which was more regulated and which was more robust. Moving from a building society to a bank meant confronting a lot of challenges. The first biggest hurdle was the legal challenges. The legal framework, the regulatory environment was completely different. Building societies were designed to be registered and deregistered only as building society. There was no legal migration path. So it required doing 14 amendments to the Building Societies Act to allow that. The second one was the onerous regulatory requirements. Suddenly, you move from the registrar of building society then, who didn't have the capacity to supervise, and you go now under the supervision of the central bank, which had really established authority, had the capability. So it became very, very onerous, meeting things like cash ratio, liquidity ratio. Those became new concepts to be complied with. The capital requirement was also completely different in terms of it. So one was at 5 million shillings, and you go to 150 million shillings. So that was, the second one was human capacity. In a building society, it was simple one fit product for all. And suddenly you now go to complex, sophisticated products like treasury products, LCs, guarantees, clearing house, and again that then. And lastly, the other big challenge was the issue of competition. Suddenly, you now come direct confrontation with the established international banks and government banks that sees a new entrant who needs to be stopped at the edge. And suddenly that then changes, because you are now eating their pie. And the pie was very small. It was only 4% of the population that had bank accounts. And suddenly, you're coming to partake to this. So, of course, competition became quite stiff. So I would say those are the 4 major challenges that we had to really confront. But the most tricky one was really getting human capacity, human resources that had the competence to be able to take us on the new path. The biggest failure came to a great extent by mismanagement. As we said, the competences, the skills were not very resident in the majority of the people. The conflict between ownership and management, particularly in governance, was also a major cause. And the reason why we succeeded was very strong governance structures from the onset. We separated ownership and management, and that helped us a lot. I myself came as a manager. I was not in the ownership structure. And that separation allowed us to really manage what we could say conflict and a greed that was eminent, that when people saw money, they assumed it was their money and not the depositor's money, and diversified their investment using insider borrowing. So we were able to avoid that curse. The second one, of course, was that helped us was at a very early stage, we started seeking support from outsiders. I remember in the early 80s, we got technical support from DFID, Microsafe, Swiss Contact, that helped us to understand some of the concept. And lastly, it was the desire to succeed. We had a burning desire, at least to create an indigenous organization that could survive, because, as I said, the whole environment was littered with the graves of indigenous. Almost 30 had failed. So the determination that truly we are going to have one of our own, making it to the other side so that it can be telling the story, inspired us a lot to succeed. Looking back, there are 3 factors that stand out that made equity succeed where others failed. And the first one was a different business model. Equity creatively and innovatively redesigned the banking model from the traditional one. We wanted a banking model that was relevant to the people, accessible to the people, and affordable to the people. So we moved from the traditional banking model to a low margin, high volume business model driven by technology to minimize cost. So we reduced the cost of access by a factor of 9. We reduced the cost of banking, the real financial cost, by a factor of 4. And essentially, that helped to open the opportunity. The second thing that helped equity succeed and resonate with the masses was product development. We developed unique capability in product development, such that we could develop products that were relevant to the farmers, whether it's a savings account, whether it is a borrowing account, whether it's a micro account. That helped us a lot, such that we developed products that answered to the needs of the previously excluded. And lastly was our unique way of seeing risks. We started seeing risks differently. When the banks thought of banking the only 4% that was bankable, we said then this is a niche. 96% that is not banked is the market. And we asked, why do we see the risks that are being seen that makes this 96 to be excluded? We see it different. And that helped us to develop methodologies like group lending, group guarantees that could mitigate the risk. So our unique perception of risks different from any other bank into the market, a different business model, and a range of products and services that were tailor-made to the unique circumstances of this excluded population, enabled us to be accessible to the unbanked population. Going forward and casting our eyes to the next 10 to 20 years, banks are confronted by enormous challenges. The first one is technology innovations. Technology is bringing previously unimagined competition into the banking space. We've just talked about mobile money transfer. What people call mobile banking. Again, that has brought telecoms into the banking space. That it would be would have been the least expected source of competition. So we're saying that in the next 10, 20 years, banks might be disrupted by use of technology. Things like Google, things like Facebook, are coming in, and you'll never chains and suppliers may threaten banks. So it is unlikely that competition will come from the traditional bank environment. The second challenge that banks have to contend with is consumer protection and consumer agitation. In the past, banks have dealt by and large with consumers who were not very exposed. This was their first relationship in financial service, and banks were more privileged to be more knowledgeable than the customer. But certainly the customer have changed. The customer is now educated, they know their rights, they're demanding. The third challenge that undoubtedly will pose a huge challenge to the bank is what we could call demographic changes. Banks were used to, on average, to have a customer who was on above 40 years, 50 years, with a demography that shows the average age of the population will be 25. But I don't know, banks will have to do a lot to adjust to these unique Generation Y and Generation X type of customer with very different demands, with decorporatization, where banks were used to dealing with corporate customers, and suddenly that has been decorporatized to what you could call SMEs and informal learning. Then it's the onerous challenge of learning how to deal with this new customer is likely to be a huge challenge. However, with these challenges also come huge opportunities. This younger Generation Y, Generation X is likely to give banks a huge opportunity of using technology. The technology savvy, they are very knowledgeable, so they know what they want, they can articulate. That is a huge opportunity to move from brick and mortar to technology as a delivery channel. The possibility in the 20 years that we are casting our eyes to, that the economy will move from a developing third world country to a middle income economy, shows that a huge number or a huge proportion of the population will transform into middle income. And again, with larger amounts of disposable income, higher appetite for facility, higher capability to take greater loans, provide banks with enormous opportunity. The East African integration and hopefully larger trading blocks, COMESA, SADC, all coming together, then create a huge marketplace out there for banks. And lastly is globalization, and partnerships at a global level gives the banks both a threat of competition from global banks, but gives them an opportunity of learning and creating synergies of collaboration with others. So I would see both playing into the market, and it depends on the strategic positioning and strategic preparedness for the bank to deal with both the opportunities and the challenges.